Hi, this is Vijay Bambwani, and in this video, I want to touch upon a very critical aspect of day trading. Please remember, I'm underscoring the word day trading. A day trader is somebody who initiates a trade in the beginning of the session and does not allow the trade to span over or spill over to the next day. So you go flat out, which means close your positions by the end of the day, irrespective of whether it's a profit or a loss. So a lot of viewers have asked me this question as to how much capital should they allocate to day trading. And I'm going to answer this question in the simplest possible manner. The simple manner being, how do I do it? What do I do in terms of capital allocation? Feel free to disagree with me or even follow this system if you like it. First of all, there are a lot of myths floating around in Siberia. By Siberia, I mean the public domain, the www, the internet, call it what you will. There are a whole lot of theories going around as to how much capital you really need for day trading. Some people actually claim that you don't need too much money for day trading. And some people are of the opinion that your account must be well capitalized to be able to day trade. I belong to the category which feels that your account must be well capitalized. You see, trading is a psychological endeavor as much as it is physical, if not more. So, how your mind behaves is extremely important, and it's not about the fastest computer, the fastest internet connection, the fastest refresh rate of your trading terminal alone, which will determine whether you'll make or lose money for that day. But it's your idea for the day that will make you your money. And believe me, your subconscious mind is extremely alert with what's happening around it. Take, for example, I have this habit, and it's a habit which I've developed or acquired over many decades. I've been trading this market since 35 years, 28 of which are as a founder, promoter, and CEO of a limited company that trades for a living. Now, my habit is I take notes of each and every counter, where the supports and resistances are likely for the coming trading session, where I would go long, where I would go short, where I would, if at all the trade initiates, I would book profits or keep stop losses. Now, unless I do this, my subconscious mind is extremely uncomfortable and I'm trading like a wet hen the next day. I lack conviction, I'm jumping around a little too much. At the slightest hint of reversal or trouble or a mark-to-market loss, I get nervous because the preparation is lacking. Similarly, if my account is undercapitalized, if there's very little money for the day, I know that I won't be able to stand my ground if the trade goes against me, and then again, I'm trading nervously. So, number one, your account has to be well capitalized. And in this day and age of rising span and exposure margins, it's a myth propagated probably by non-market participating experts who don't know much about trading, that you can start with 5, 10, 20 or 50,000 rupees. Try trading a lot of Nifty, one single lot of Nifty, unless you have 1,25,000 or 1,30,000 rupees in your account. Your broker's computer trading terminal is directly linked or mapped to the back office to your margin funding account, where your order will be rejected for lack of funds. And if you want to do 2, 3, 4 or 5 lots, which is what you will need to do to make sizable amounts of money, forget about starting with 10, 15 and 20,000. Now, how much of my trading, my total capital do I allocate to trading? I'm talking about me. Feel free to disagree. Feel free to adopt this system. You see, I love talking to people on the weekends, especially like-minded people in the same line of business who put their money at risk in the market to earn a reward called a profit. So these are doers of deeds, not just master of the spoken word. Now, what I have found through trial and error is that I'm happiest, or I'm the most comfortable when I allocate no more than 15 to 20% of my total capital in trading, day trading, I mean. I'll tell you why. Now, the most underrated, least understood, and to most of the people, the most boring market is the fixed income market. It's not surprising because at the end of the day, no matter what happens, you're going to take home, like the word says, fixed income, a fixed amount of money on your investment. People find it extremely boring. They want to be millionaires overnight. Enter a trade, make 500,000. Enter another trade, make 1 million bucks. Now, it's not really how it works. There are times when you have to dig your heels into a trade, wait for the trade to fructify, and a trade is like a military operation. It doesn't really go as per plan. There are a lot of variables, there are a lot of unforeseen circumstances which can come between you and closure of the trade, and therefore the trade can get prolonged. And it might even result in a loss. All right. So your account needs to be capitalized, but at the same time, when I'm trading, I'm trying to put food on the table for my family with the trading profits, knowing fully well that the back of my mind, or the subconscious mind, remember what I told you about the mind being uncomfortable when it is not prepared. The subconscious mind must also know that there is a plan B if my trading is not really taking off, or if at all there is a month in which I run a string of losses. Is that possible? Yes, definitely. You could be making money on some days, losing money on the next day. It could happen. This flip-flop would give you either very little or no money for the month, or it might even result in a loss. But hey, the domestic help salary has to be paid. Electricity, telephone, and other utility bills have to be paid. So plan B is what differentiates a successful trader from a mediocre one. A majority of my capital is invested in fixed income. I, for one, am a big fan of sovereign debt. Sovereign debt meaning lending money to the government in investment schemes which are guaranteed either by the central government or by the state government. I prefer central government securities more than state securities. Not that state government securities are not treated as sovereign, but hey, that's just me. Now, why do I prefer sovereign guaranteed securities? Because the government runs the printing press. If at all it finds trouble in repaying me on my fixed income securities in the sovereign guarantee, it will simply print currency and pay me back with that money. At least I won't lose that money, which I run a risk of losing in private sector fixed income investments. So, with falling interest rates, I agree that my fixed income is falling. So I need to put in more and more amount of money in the capital to be able to get the same amount of interest per month. And since trading is high risk, but it's leveraged, I trade in the futures space. All right. Now, the very fact that I'm leveraging in futures means that I'm taking exposure 10 times more than my capital, sometimes even 12 times more than my capital in the indices, the Nifty and the Bank Nifty. And I'm taking up to 6 times more exposure as compared to my capital in individual stock futures due to the span margin structure. If at all you want intraday limits, at this point in time for this quarter, SEBI has allowed brokers 4x, which means 4 times the amount of leverage that is normally allowed, and it is to be progressively brought down by 25% over the next 4 quarters, so that by the quarter ending September 2021, you will not get intraday trading limits. At least that's what the plan is. So right now, if I don't take brokers margin funding, I'm leveraging my capitals 10 times in intraday. If I take brokers margin funding, it's 40 times. In individual stocks, it is 5 to 6 times. If I take brokers margin funding, it is 25 to 26 times. Now, when you're taking exposure of such high magnitude, you are obviously taking a risk and reward backlash which is significantly higher than the delivery guys. Which means my exposure is enough, paying only 15 to 20% of my capital in day trading towards span margin, mark to market, and exposure margins. A majority of the money is into fixed income, preferably sovereign debt. Of course, you can also allocate money to capital appreciating assets like equities, maybe some amount in bullion. Some people may even be big fans of real estate, where they feel over 10, 20 and 30 years real estate prices do tend to appreciate, and therefore some allocation must be made there. By all means, feel free to invest this money in percentages in allocation methods that are most comfortable with your aptitude and attitude. But believe me, more than 15 to 20% of your capital in trading would mean that you're going to overtrade. Of course, I'm going with the assumption that the capital base itself that you have is a reasonable, fairly big ticket size. So 20% of that amount will also come as a very reasonable and decent figure. Friends, this is my therapy, or this is my recipe for capital allocation towards trading. I would love to hear your thoughts in the comment section and let me know what you think of this. I bid goodbye to you in this video, not before reminding you to click like on this video if you agree with what you see. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive alerts about new videos being put up here. Also, help me reach out to fellow like-minded traders by referring my video to your family and friends. I wish you have a very, very profitable day ahead. This is Vijay Bambwani signing off for now. Thank you for watching. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.